Hi guys, AMP recently released a new product, a 10-year interest-free loan product that I want to talk about today here from my backyard because it offers a way for property investors to get far richer using 3 strategies. Now, I posted about it in my Facebook group, and a lot of people said that it's not a good idea and that you should always go principal and interest. You know, when you get a loan, always pay off the principal plus the interest. Don't go interest only. But in this episode, I want to talk about how this new, relatively new product in the Australian market, 10-year interest-only period product loan from AMP, allows property investors to basically make hundreds of thousands of dollars whilst paying jack all on property holding costs. I'm going to explain 3 strategies, and this may completely change your perspective and approach on property investing and may actually encourage you to buy your first property or scale your portfolio because you realize that the way that you've been doing it has been not optimal the whole time. Okay, so let's go. Now, 10-year interest-only periods were actually pretty common in Australia maybe 20 years ago, 15, 20 years ago. And in fact, even before AMP launched this one, there was ANZ and a handful of other small lenders that did offer 10-year interest-only period. But now with AMP coming into the market again with this product, it's becoming more and more common. And I actually feel, and my personal opinion, is that as house prices become more and more unaffordable in Australia, generally speaking, the banks and APRA, the regulatory authority for the banks, will actually allow them to offer a 40-year home loan period because that allows people to pay off their home loans over a 40-year period as opposed to 30-year period, which means that they're able to borrow more, their borrowing capacity will increase, and it will allow more people to get into the market. But that's not the topic of this episode. The topic of this episode is how we can use these specific 3 strategies that I'm going to talk about to get rich faster as property investors using this 10-year interest-only period product. Now, I do want to mention at the end as well, at the end of this episode, I'm going to mention 2 of the downsides of this product and 2 downsides of interest-only lending. And I think it's very important for me to be balanced in my view. So we'll go through the pros and cons. But effectively, the first way you can get richer faster, if I can use that term. And forgive me for just randomly walking around in my backyard. It's just a good day and I just thought I'd do this video outside. So the first way, a 10-year interest-only period product from AMP or any other lender, ANZ for example, it allows your holding costs to basically be nothing. So let's say you put down a 20% deposit, maybe a 25% deposit on a, let's say, $500,000 house. Now, of course, you don't need to buy a $500,000 house. You can buy a $350,000 A-grade investment property, $400,000 A-grade investment property. By paying interest only, you're actually preserving the cash flows from that property and ensuring that that property pays for itself. Now, you might say, well, PK, it's pretty hard to find a positive cash flow property right now in Australia, and I wouldn't disagree with you. Of course, so many people are buying positive cash flow properties, and I don't mean in mining towns. And they're also buying in a way that they do a small cosmetic renovation and that increases the rent so it becomes positive cash flow. But let's ignore renovation for a time being. Let's just say that you buy a property with a 6% yield or a 7% yield, which are plentiful, especially in sort of central Queensland and regional Victoria, even in New South Wales and the regional towns, you know, diversified towns like Wagga. I'm not talking about mining towns or anything like that. Now, for the first few years, that property may actually cost you, let's say $2,000, $3,000, $4,000, $5,000, etc. to hold. But as interest rates come down and the quantitative easing cycle has already begun, we don't know how many times the RBA is going to drop rates or whatever, but it is going to happen at some point. I think the consensus is pretty clear on that. But even if we put that argument aside, we put down the argument that interest rate reductions will make properties positive cash flow. Even putting that aside, we know rents will go up. There's a huge rental crisis in Australia, rental shortage, not enough properties for rent. And especially if you buy in the right suburbs, the right types of deals, those rents are going to go up. So over a 10-year period, remember the interest only period is for 10 years, over a 10-year period, net, first few years the property might cost you a bit to hold. The last few years it's actually going to give you a lot of income because rents will have risen. And in the middle it might be around neutral. So on a net basis, because you haven't paid principal, over the course of 10 years, that property's not cost you anything to hold, right? Does that make sense? The rent has covered all the outgoings, including maintenance and interest and everything like that. It's cost nothing to hold on a net basis over a 10-year profile. And in that 10 years, of course, not all properties double in 10 years. That's a myth. But if you buy the right property using a whole suite of data metrics that I believe strongly anyone can do, because I've proven that over almost a decade with more than 1,200 clients now, then if that property, let's say, goes from 500,000 to 1.2 million, okay, you can sell that after 10 years. Of course, you got to pay capital gains tax. But you're still making like $400,000, $500,000 of post-tax profit, okay? And that's the beauty of this interest-only period product, this 10-year interest-only period product by AMP, and I think ANZ does it, a couple of others do it as well. Over the 10-year period, you've paid nothing net to hold the property, yet that thing has gone up so much. And then after tax, you've just made bank. So that's number one strategy, how you could think about embracing interest-only period loans because they don't impact your household cash flows, but allow you to get rich faster. Number one strategy. Number two strategy is actually you can refinance that 10-year period. So after 10 years, I'm recording this in 2025, let's say we're in 2035, and you're like, actually, the property's more than doubled. It's gone up 150%, as is not uncommon if you choose the right property, or it's even, tripled, let's say. And you're like, I don't want to sell my golden goose. It's giving me passive income. Now my positive cash flow, it's going up steadily. You can actually go to the bank, provided you have enough borrowing capacity at the time, and say, Mr. Bank, I want another 10 years added on, or at least 5 years added on. And provided your financials are okay in terms of your borrowing capacity, your income, etc., they'll say, yep, cool. They'll refinance it. You'll get another 10 years. So it's another 10 years of no holding costs, and you just got skin in the game with basically zero burden to your household budget. And then you're enjoying another 10 years of capital growth. I mean, that's just beautiful. Not all countries have this facility. I mean, we're in Australia, we do have it. So why not make the most of it? And the great thing about the second 10 years is that the property will already be positive cash flow from the very first year post extension. And so you're probably going to be making tens of thousands of dollars of positive cash flow, hundreds of thousands of dollars of capital growth. And it's just like, really, it's a no-brainer. If you ask me, paying principal and interest is basically forced savings. Paying down the principal of a property, even though you may think, yeah, I'm increasing my equity that way. True, you are increasing equity, but it's just forced savings. Like, you're not actually investing. That's just forcing you to save as if you put that in the savings account. Investing means buying multiple assets and letting them go up, not just saving as hard as you can. And that's really what paying principal and interest does. Principal is just forced savings. Now, the third strategy, this is the one that I'm most excited about. Think about number one and number two on steroids. So think about this. Instead of paying principal and interest on one investment property, why not pay interest only on 2, 3, 4, 5 investment properties? Now, everyone's household budget is different. Not everyone may be able to do that immediately, but at least consider, instead of paying principal and interest on one property and your household cash flows are significantly affected, pay interest only, and that way the property basically pays for itself net over a 10-year period, and you're able to hold 2 or 3 of them because you're only paying interest, not interest plus principal. And of course, that same principle in number 1 and number 2 strategies that I just talked about, if those properties double, triple over the course of 10 years, would you rather have bought 1 at 500K or 3 at 500K? Would you rather one asset at 500K rise to 1 million or 1.2 million or 1.5 million in 10 years time, or would you rather 3 assets each bought at 500K rise to 1.2, 1.5 million each? Of course, the answer is pretty common. It's you rather have 3, and that's the beauty of interest only. It allows you to have better surplus. It allows you to have a better household cash flow surplus because you're not paying principal, and allows you to hold and control multiple assets. And as those rise in value, then you're making far more wealth for you and your family. So those are the 3 strategies. I'm not talking like theoretically. This is all based on stuff that I've actually done, that my clients have done, so many people have done. It's actually not so groundbreaking, but I still find that a lot of investors don't understand this, and therefore their mentality is, okay, let me just buy one investment property, pay it off, it's safe. But safer, in my perspective, humble perspective, is to get richer. And the more wealth you accumulate through the right strategies, the more wealth makes you safer in terms of your future financial independence and financial freedom. And of course, this same principle can be applied to your own home. Should you pay off your own home by paying principal and interest? And of course, your own home, there's other considerations there, emotionally, etc. as well. But the same principle applies. Instead of trying to pay your own home off, why not take that same $50,000 that you're about to pay off your principal in your home loan, your personal home that you live in, your PPOR? Why not instead use that $50,000 to buy an investment property? As that rises much faster than you could save through your job, then you could sell that property in 5 or 10 years and completely pay off all the debt in your PPOR. So there are faster ways of achieving the ends than just paying principal, okay, which is forced savings. Hopefully this is making sense. The 2 downsides, which I think are obliterated in terms of the upsides, but it's worth mentioning anyway just to be balanced. The downsides of paying interest only is that it affects your borrowing capacity. So if you do go interest only, maybe your borrowing capacity is a bit less. I don't want to put an exact number on it because different lenders, whether it's a big 4 bank or a 2nd-tier lender, 3rd-tier lender, they treat it differently. But it is the case that your borrowing capacity is a bit less. But once again, this strategy or these strategies that I'm talking about are really for those people who have a clear vision and have a clear goal and want to get into the fast lane. If you want to be super risk averse, leave money on the table, not achieve your potential financially at least, then maybe principal and interest is okay for you. Everyone's different. I don't want to be here judging. And the second downside of going interest only is that the interest rate you pay might be 0.3%, 0.2%, 0.4% higher than if you had gone principal and interest, okay? The banks charge you a higher interest rate if you go interest only. And I think so many people still in this day and age are obsessed with getting the lowest interest rate, but that's really the mindset of those who aren't financially literate. It doesn't matter what interest rate you get. What matters is how many properties, not just how many properties, the quality and quantity of assets or properties that you hold, because the higher amount or the higher quantum of properties, quality properties that you hold now will mean that your wealth in the future has multiplied across multiple assets and will be higher. And in that way, paying an additional 0.3% interest rate over 10 years is just going to be like pocket change. It's going to be meaningless. Would you rather save 0.3% of interest or make another 3, 4, 500,000, $1 million, $2 million over the course of 10 years? I mean, you have to be, you have to try to stray away from being myopic and short-sighted in order to make these decisions correctly. Okay, I'm gonna leave it there. I have so much more to say, but I think I'll end up waffling. But hopefully this gives you value. My name's PK. Hit the subscribe button if you get value. Give it a like and share it. You know, I know so many of your friends, colleagues, family, etc. won't understand these concepts, so make sure you share it. You know, don't hog this knowledge so that they too can get ahead. And all it takes is these types of conversations and something can click and all of a sudden someone achieves financial freedom in 10 years time. Thanks for being with me. My name's PK. I'll see you next time.